We're beginning the reading Cost of Capital, Foundational Topics. We don't have a lot to get through here, 7 learning objectives, and it's only about 20 pages. We're introduced to the cost of capital, specifically the weighted average cost of capital. Look at our keywords here, calculate, interpret, are in quite a few of them. 2 pages onto LOSB, incorporating taxes into the cost of capital. Super easy, as you can see, 1 page. And then we go into each of the components of capital: cost of debt, cost of preferred stock, cost of common equity, all calculate and interpret. 3 pages, 1.5 pages, 4.5 pages. That gets us to the end of LOSE. Then we have explain and demonstrate for both estimating beta and how we're going to deal with flotation costs. 4.5 pages here, and we wrap up with 3 pages. Really short, really quick, under an hour. Let's go. Cost of capital. Foundational topics. We're on LOSA, calculate and interpret the weighted average cost of capital of a company. Capital can be broken down into debt and equity comes in 2 flavors, preferred and common, and each component of capital has its own cost. So there's a cost of debt, there's a cost of preferred equity, and a cost of common equity, and much of this reading will explore how we arrive at the cost of these components of capital. New investments or company capital projects will require new capital to be put to work to support those investments. The cost of that capital is the cost of raising additional capital of the same type. So we refer to it as the marginal cost of capital. So a company may have, if we look down here to really understand the difference between an existing cost of capital and the marginal cost of capital, let's say that a company has a low level of debt issued right now, and we'll say that this is the cost of debt down here, or the level of debt, and this is the cost of debt. If they add an incremental amount of debt at this low level, it may have no different cost than its existing cost of debt. They may be able to issue new debt at the same cost of their existing debt. However, after they get to a certain level, the cost tends to rise. So let's say that they were at this level of debt over here, and they wanted to issue debt to get to this level of debt. Notice here that the marginal cost of capital, the marginal cost of debt, gaps up. And if we're going to raise money to bring our debt from this level to this level, we have to use the cost associated with raising that capital, because that's the new capital that will support the new investment. So what is the cost of getting those funds in place? So we look at the marginal cost of capital. A cost of capital is really just the required rate of return that we need. We have to cover our cost of capital, and rather than write out cost of capital, I'm just going to shorten it from here on in the video to C, little o, big C, COC. The company cost of capital is the required return for the average risk investment or project for a company. So if a company is taking on a new project that has a different risk profile from the average risk profile of the average investment of the company, you would use a project-specific cost of capital, a cost of capital that reflects the risk of that particular project. However, if it's just taking on investments that look like every other investment that it's taken on, we can use a company-level cost of capital. So other than really small investments that are typically done out of cash flow, when a company is considering a major capital investment, there's always the decision of, well, how much equity are we using? How much debt are we using? So they tend to use a variety of sources of financing for particular projects. As such, we can't just look at the cost of debt or the cost of equity, but we have to weight the cost of these with the proportion in which they're used. We get to what's called a weighted average cost of capital. So companies use a variety of financing for each investment. Therefore, the weighted average cost of capital is used, WACC. Sometimes you'll see it in lowercase letters. Sometimes you'll see it all in uppercase letters. It's the same thing. It's just different authors have different preferences for the style notation that they use. Also referred to as the marginal cost of capital, MCC. So if you see MCC or WACC, it really means the same thing. When we calculate a weighted average cost of capital, the costs of the components are marginal costs, hence it being a marginal cost of capital. It means the same thing. Here's our weighted average cost of capital. We have the weighting on debt times the cost of debt, of course on an after-tax basis. We'll talk about that shortly. The weighting on preferred equity times the cost of preferred equity. The weighting on equity is common equity times the cost of common equity. When we say the cost of, we mean the required rate of return on that. When we use the words required rate of return, I as the investor refer to it as my required rate of return. Well, my required rate of return is the company's cost of that capital. So R means cost of, and then the sub D is debt, sub P is preferred, sub E is equity, W are weightings. The weights are the proportion of the various sources of capital of the company's target capital structure, not the current capital structure. If there is no information given about a target capital structure, but there is information given about how financing is going to be raised for that particular project, we would use the weightings for that particular project. If the company is raising money in proportion to its existing capital structure, then we use the existing capital structure. How we keep all of this straight is we go through some of the examples in the reading and, of course, some of the examples in the end of chapter. So let's look at an example here. Let's say that a company has this capital structure. 30% of their capital is debt, 10% is preferred, and 60% is equity. Required rate of return from current shareholders, debt 8%, or current capital holders, debt 8%, preferred is 10%, equity is 15%. They have a 40% tax rate. The weighted average cost of capital is the weight on debt times the cost of debt on an after-tax basis, because interest is tax deductible. So if I'm paying 10% interest and I have 40% tax, if I don't pay the interest, I got to pay the gain in tax. So if I can reduce my income by $100 because of interest, I save $40 in tax. That's why it's on an after-tax basis. The cost of preferred, the weighting on preferred times the cost of preferred, the weighting on equity times the cost of equity. It's just weighted. All your weights should add to 1, by the way. And we get 11.44%. LOSB, really quick, just a couple of lines here, and we just took care of it on the last screen, but let's do it formally. Describe how taxes affect the cost of capital from different capital sources, and it only affects debt. It doesn't affect preferred or equity. If interest expense is tax deductible, which is typically the case, the after-tax cost of debt is the pre-tax cost of debt 1 minus the tax rate. If it is not tax deductible, or if limits on deductibility apply, the cost of debt just equals RD. This is extremely rare. It is typically the case that there'll be a pre-tax cost of debt multiplied by 1 minus the tax rate to get an after-tax cost of debt. So if our pre-tax cost of debt is 4%, our pre-tax cost of equity is 6%. Let's say we have a 30% tax rate and a 48% tax rate. Our after-tax cost of debt and our after-tax cost of equity are as follows. Notice that equity doesn't matter. Dividends are not deductible on income. And if it were preferred, those dividends are not deductible either. So it falls outside of the income statement. It comes on the line below net income. So there is no tax shield associated with disbursements to those capital holders. So there is no difference between pre-tax and after-tax. Debt, on the other hand, has a tax shield. So if it's 4% that we're paying in interest and our tax rate is 30%, we multiply 0.04 by 0.7. That means it is effectively really only costing the company 2.8%. To see that, imagine that there's $100 in debt and you have to pay $4 on that 100. You have now $96 of net income of which you have to pay tax on. If you didn't have that $4, you'd have to pay tax on that $4, which means the company would lose at 30%. It would lose $1.20 anyways in taxes. So by having the $4 deduction, you don't have to pay the $1.20. Well, 4 minus $1.20 is $2.80, 2.8%. 4% down to 2.8%, right? And if it were 48% tax, notice our after-tax cost is 2.08. Let's point out something important here. We've given you the same scenario, the same pre-tax cost of debt. We've just raised the tax rate from 30% to 48%. Look what happens to the cost of debt. It drops, which means companies then would say, listen, facing a higher tax rate, it makes a lot more sense for me to finance a lot more of my capital projects going forward with a heavier amount of debt because it's cheaper. And that is a regularity, an empirical regularity you'll see, is regions that have higher tax rates tend to have companies that are more highly levered. LOSC, calculate and interpret the cost of debt capital using the yield to maturity approach and the debt rating approach. So now we're going into each of the components of capital, and we're going to figure out how we arrive at R sub D, R sub P, and R sub E, which is the cost of debt, cost of preferred, and cost of equity. We're starting with the cost of debt, which is R sub D. Yield to maturity approach. If you've been through fixed income, this is just calculating the yield to maturity of a bond. I know the price of the bond, I know the future value of the bond, I know how many years the bond is for, what the coupon rate is, and I calculate a yield to maturity. Same thing. The annual yield an investor holds on a bond if held to maturity. This is a general formula for it. We will know the current price. We could just look at it. The coupon is stated, so we can figure out what the payment, each payment is. We'll know what the periodicity is, so M is our periodicity. And then, of course, our future value is always the face value of the bond. So just to help demystify the formula here, if the periodicity is 1, if it's an annual bond and it's for 10 years, this will just be 1 plus r to the power of t. This will go away, and nm will just be 10. So it's through, the periods 1 through 10, 10 payments plus our future value. Or you could just use your calculator, right? We'll know the future value. We'll be able to figure out our payment, which is the coupon divided by its periodicity. N is the number of years times the periodicity. PV is negative, P naught. And then we'll compute our yield. But our yield will be on a periodicity basis. So we'll just multiply by the periodicity. There's our cost of debt right there. That's how we get to R sub D. Example 3A shows an application of the yield to maturity approach. Plenty of this in fixed income, so I don't think we have to, dive deep on this. 10-year bond, $1,000 face value, 5% semi-annual coupon, selling at $1,025. The company has a marginal tax rate of 35%. That'll help us figure out our after-tax cost of debt. So let's arrive there. To get the cost of debt, the pre-tax cost of debt, to get all the way over here, this is RD. Our payment, present value, negative 1,025. Our payment is 25 because it's semi-annual, right? Our N is 20, 10 times 2. Future value of 1,000, compute the yield, 2.342. But remember, this is a semi-annual basis, multiply by 2 to get an annual yield. Then we just multiply by 1 minus t. If t is 35%, 1 minus t is 65%. There's your after-tax cost of debt. You're going to see quite a few of these questions in the end of chapter questions that ask you to calculate. Well, they don't ask you, but they ask you to calculate weighted average cost of capital. On the way there, you're going to have to calculate the cost of debt. It's not given to you. And in fixed income, you're going to see a lot of this. The debt rating approach. When reliable current market prices for the company's debt is not available. If you have market prices for the debt, just use that. It's the most direct way to get a cost of debt. If not, well, we're going to have to get creative. This is based on the company's debt rating of the issue itself. In fixed income, in the reading fundamentals of credit analysis, you will learn that a company has a particular credit rating, let's say it's A, but the company's credit rating is on par with its senior unsecured debt. Well, it may have secured debt and it may have junior or subordinated debt, which will have a rating different than the company rating. So we want the rating on the debt issue itself. Use the yield on comparatively rated bonds for maturities that closely match the company's existing debt. And 3B gives an application of this, assumes a company has average maturity of debt of 15 years, rated A1, its tax rate is 18%. Comparative yields, 6.1%. So we'll use the 6.1%. Typically, getting to the 6.1% is arrived at using a process referred to as matrix pricing. You will see that in the fixed income section. From the 6.1, we may decide to go higher or lower than the 6.1 based on the characteristics of the bond we have, whether it is secured or unsecured, whether it is callable or straight. Once we have the 6.1, this is our RD. We would multiply by 1 minus the tax rate to get our post-tax cost of debt. So before we think that estimating the cost of debt is really straightforward, there are some issues. Number one, fixed or floating rate coupon. If it's a fixed rate coupon, that's really easy to do. We have a known cost. We know exactly what the coupon payment is, every coupon payment. But if it's a floating rate, you have an unknown cost because it depends on future yields, where yields are going to go because it is a floating rate. you can only end up with an estimated cost only. We don't have to get into how we would deal with that. This section doesn't do that. This section just says, hey, by the way, be aware of this. It's not as simple and straightforward as the examples we gave you lead you to believe. Debt with option-like features, whether it has calls, puts, or conversions. And by the way, at level 2 fixed income, we are going to deal with bonds with these and price out bonds with options in them. Bonds with calls will raise yields. It'll raise the cost of the debt. Puts and conversions will lower the yields. If a company has existing debt with similar features, great. We could just use that yield to maturity. If new debt will add or subtract features, then adjustments need to be made to any existing yield to maturities. We don't really get into how to do any of that. We just need to be aware of it. Non-rated debt. A company may not have any debt at all or have unrated debt. A synthetic rating can be approximated based on financial ratios, so we can create a synthetic rating for the company and then use that synthetic rating and find peers of that rating. However, it's not a very accurate approach. It is mentioned as a way to, create a credit rating where none exists by saying, well, listen, if we were a credit rating agency based on its ratios, what rating would we give it? And then go from there. But it tends to be very, very subjective, so it's not very accurate. And the fourth issue mentioned are leases. What if a company invests in assets by leasing them? We think of an airline or a railroad that says, well, I'm not going to buy the planes or the rail cars, I'm going to lease them. We know from lease accounting, from FRA, the reading on long-term liabilities, that all leases, whether operating or financing, must now be listed on the balance sheet. The present value of all future lease liabilities. So there's an implied rate in all leases. That's the cost that is used if leases are used. We'll use the implied rate in the lease for the cost of capital. All right, there's debt behind us. LOSD. Calculate and interpret the cost of non-callable, non-convertible preferred stock. And it's very specific here. Read that LOS. Non-callable, non-convertible preferred stock. Yes, there are a lot of features on preferreds. And when we look at preferreds, we would adjust the cost of the preferred based on the type of features that we have. But let's look at fixed rate perpetual preferred shares. Perpetual means they are non-callable and they are non-convertible. The cost of the preferred share is just the dividend over the price. No tax adjustment, since preferred dividends are not tax deductible. And adjustments must be made from here for features like callable preferred, cumulative, or non-cumulative, cumulative versus non-cumulative, I should say, participating or non-participating, and or adjustable rate dividends, and also for convertibility. Don't get into any of those in this reading at all. The LOS is very clear. It's just the cost of non-callable, non-convertible preferred stock, and it will be that straightforward. You'll either be given something like D0 and a price. D0, since they're fixed rate perpetual, D0 is equal to D1 is equal to D2, on and on and on, and whatever the price happens to be. Or you may be given the cost and asked to determine what the price is. Here's an example from the reading itself. $375 a year cumulative dividend. The price is $80. Well, if it's $375, we're getting off of 80. You can see that for an investor, the yield is 4.6875%. That's the cost of the preferred share to the company. All right, LOSC, the last component of capital here. Calculate and interpret the cost of equity capital. And we have two approaches here, capital asset pricing model and the bond yield plus risk premium approach. Equity, we should be clear, includes new issuances and retained earnings. Even if a company is going to finance a new product from retained earnings, that is a component of equity, because that money could be returned to shareholders. It could be used to rebuy existing shares. So it is going to have an opportunity cost. Well, that's the cost of equity capital. Capital asset pricing model, the expected return on equity is equal to the risk-free rate plus beta times whatever the equity risk premium is, or the market risk premium. This is a single factor model. The single factor is the market itself, and what we're saying is that the cost of a company's equity should be proportional to the risk in the market scaled by a beta factor, and beta tells us whether or not our company has a return series that is more variable or less variable than the market. If it's more variable, it's higher risk, so we should get that. And this is a risk premium. When we say premium, it means in excess of, and here it's in excess of the risk-free rate. This is the return on the market minus the risk-free rate, called the equity risk premium. And a premium is what you get up and above something else. We're going to get risk-free rate on its own, right? The risk-free rate that we choose should be consistent with the life of the investment. So if it's a 10-year project that we're investing in, we should use a 10-year risk-free rate of return. And everything is pretty straightforward from there. So let's say that we have our equity risk premium, the return on the market minus the risk-free rate, given as 7%. Now you got to be careful here. Because this is a great way to mix you up. Maybe some questions will give you the market rate of return and the risk-free rate of return. Other questions may give you the equity risk premium or the market risk premium already. Remember, it's the return on the market minus the risk-free rate gives you the market risk premium. Risk-free rate 5%, beta of 1.5, plug and chug, right? 15.5%. Here is an issue with it. Let's look at Exxon, BP, and Mobil. These are all global integrated oil companies, or what they like to be called these days, energy companies. You would seem to think that the cost of equity should be independent of any existing market that they're in, but they're all in different markets as far as their home base is concerned, but they're in every market in the world. Exxon, BP, and Mobil versus their own stock exchange in their own market have these betas. And this is the equity risk premium in their given markets, the risk-free rate in their given markets, and the cost of capital. Does it make sense for Mobil to have a lower cost of capital when it does the exact same thing as Exxon? The only reason Mobil has a lower cost of capital is because it's in a country where its relationship with its market is more subdued and the market itself has a lower risk-free rate. Or should we use something called a global market portfolio and use a global equity risk premium when assessing companies that have global footprints like this? This is not a problem that the reading presents you with. It just gives you this example. But if you think deeply about this, you would say, well, hang on a second now. If one company being in one country as their home office and another company being in another country as their home office compete with each other in 180 countries around the world and are pretty much global, why would they have different costs of capital just by accident of where they happen to be located, right? Something to think about. Anyways, this is fairly straightforward on how we calculated our cost of capital here. It was the risk-free rate, 2.8%, added to beta, which is 0.9, multiplied by the equity risk premium. That's it. As I mentioned on the previous screen, CAPM is a single factor model. There is one factor, which is the market factor, and we assess the expected or the required return on equity based on its exposure, whether it be more volatile or less volatile than the market. We can also use multi-factor models, and this would incorporate risks not captured, very clear here, not captured by the market portfolio alone. These risk factors are referred to as priced risks or rewarded factors, and these are factors that are commonly recognized to be risk premiums that are not captured by the market. Common ones are inflation, interest rates, or interest rate risk, currency exchange risk, business cycle risk. And it just looks like CAPM, that if we stopped right here, we would have CAPM, and if we call this the equity risk premium, there's CAPM. But we could have other listed premiums that would have other beta sensitivities associated with them. Let's dig deep a little into a CAPM, because we know it's the risk-free rate plus beta times the equity risk premium. Well, where do we get the equity risk premium? How do we get beta? What risk-free rate are we using? So let's start with estimating the equity risk premium. We have two approaches here. Historical equity risk premium approach, and with most data vendors, there are lots of estimates of the equity risk premium over different periods of time, both arithmetic and geometric, that you can use. And I'll explain the difference between geometric and arithmetic coming up with a nice little diagram. It's the average rate of return on the country's market portfolio and a government short-term or long-term rate. So in calculating the risk-free rate or the equity risk premium, you can use a short-term security like a 3-month cash rate or a long-term bond like a 20-year bond. You can also calculate the average rate of return on a geometric basis, which is a constant growth rate over time, or an arithmetic basis, which is just the sum of a whole bunch of returns divided by n. Single period, the average single period return. G is the average return over a longer period of time. Once you calculate the average and you decide, okay, do we want arithmetic or geometric, you just take RM minus RF. And again, once you've made the decision, am I using 3 months, am I using 20 year? I had mentioned previously that estimates of the equity risk premium based on the historical approach are available from different financial data vendors. Dimson and colleagues have been doing this for a while. The most recent paper is 2018. Equity risk premium geometric on a geometric basis and on an arithmetic basis using T-bills and using T-bonds. Notice the difference here for T-bonds. It's lower on both geometric and arithmetic, and for geometric is lower than arithmetic, because anytime you have volatility in a return series, a geometric mean return will be lower than the arithmetic mean return. The difference in the short term, using a risk-free rate that's short term versus long term, is the shape of the yield curve. It tends to be upward sloping more often than it is flat or inverted. And since we're estimating the equity risk premium, we'll come up with some average for the equity risk premium, which is a constant over time. If you're using the T-bond, you'll have a higher yield, hence a lower equity risk premium than if you're using a T-bill rate. Let's separate the arithmetic from the geometric. If we're forecasting an expected return or the cost of equity over multiple periods, let's say if over a 5-year period or 10-year period, using a geometric return makes a lot of sense. Using the equity risk premium from a geometric return makes more sense. It better reflects growth rates over many periods, and this is basically what we're doing. We're just taking some return rate and we're just growing it over time. So if we start with a sum of money, let's say $100, this is just growing over time at whatever the equity risk premium is. It's a geometrically compounded return series. And the distribution of the returns that we see scales with the square root of time. If we're just doing one period at a time required returns, we would use an arithmetic mean for the equity risk premium, which looks like this. You'll have a distribution of returns, and the average is the center of that distribution, and your actual observed return could be anywhere within the distribution. So let's say it's here. Well, the next period is the same distribution. You'll end up with the same distribution of returns, and let's say your return is up here, and you just keep going that way. This is a series of arithmetic returns, and to calculate, if this is our ending period, it's just a series of returns multiplied. And then if you take all of this to the power of 1 over 4, you will get a geometric mean return series, which is this line right there. So the arithmetic equity risk premium is an unbiased estimate of the cost of equity or the expected return of equity for a single period, which CAPM is a single period return. So in CAPM, we would use the equity risk premium in this column. CAPM tends to use a long-term rate, so we would use a 20-year bond, but we did say earlier that the risk-free rate should be consistent with the life of the project. Most capital projects wouldn't use a T-bill rate. They're not 3-month projects. They tend to be multi-year projects. So using a longer-term rate like the 10-year yield or the 20-year yield for the risk-free rate makes a lot more sense than using a 3-month rate. Some limitations of CAPM, and these are some limitations. If you ask most academics, they'll give you a whole long list of limitations with CAPM. Big one being it's a single factor model. Enough said, and that usually is the end of it. Level of risk of the stock index may change over time. So volatility for long periods of time may be elevated or may be muted. Risk aversion of investors may change over time, especially after a dramatic event. A lot of investors tend to be risk averse for many, many years after dramatic events. So the investors may require higher expected returns to invest, or after a long period of relative calm in markets, meaning no major bear market leading to deep recessions, they might actually require a lower expected return. And estimates are sensitive to the method of estimation and the historical period covered. Estimates of beta and estimates of the equity risk premium as well. Not to mention, when we're talking about the risk-free rate, we're talking about the average risk-free rate, so there's an estimate involved there. So they tend to be very sensitive. End result here, big message to take away, the equity risk premium is not stable over time. You can look at different periods of time and different ways of estimating the equity risk premium and come up with a range of values. Beyond the historical method, we have the survey method of determining the equity risk premium. Just ask a panel of finance experts and take the mean. It couldn't be more straightforward than that. Doesn't need any extra explanation. Once you come up with an expected return, once you take the mean, you can then adjust that mean for any specific systematic risk of any particular investment or project a company is considering. Our second method of estimating the cost of common equity is the bond yield plus risk premium approach, and this is for companies with publicly traded debt. So the cost of equity is simply the cost of debt plus a risk premium, and this risk premium represents the additional risk of the company's stock over its bonds, typically in the 3 to 5% range in developed countries. The pre-tax cost of debt, remember, is going to be a risk-free rate and a spread reflecting the riskiness of the company. So you have the risk-free rate, you have a spread to represent the risk of the bonds, and then you have a spread to represent the risk of the equities over the risk of the bonds, and you get to an estimate of the cost of common equity. So we've had a lot thrown at us here, and sometimes it helps to look at it in a sort of a nice mind map sort of way. This was our job, to calculate the weighted average cost of capital. This is the weighted average cost of capital, and we have a whole bunch of variables. The W's are our weighting based on a target capital structure. Our cost of debt we looked at arriving at using a yield to maturity approach or a debt rating approach. The cost of preferred shares is really just the dividend divided by the price of the share. For the cost of equity, we looked at two approaches, capital asset pricing model and the bond yield plus risk premium. For CAPM, we went into a discussion of how we estimate the equity risk premium. We looked at the historical approach and the survey method approach. And bond yield plus risk premium is just the cost of debt plus a risk premium for the equity, and the cost of debt has both the risk-free rate and a spread within it. So knowing that we really are focused on here and all of the variables, we have different methods of arriving at the estimates of what the variables would be. That's really what we just went through in the early learning objectives. So now we're going to focus on this variable over here, which is beta. LOSF, explain and demonstrate beta estimation for public companies, thinly traded public companies, and non-public companies. We'll start with the super simple one, which is beta for public companies. This is typically available, widely available from any financial data provider or vendor that you have. If you don't have that, you can simply just get a return series for a particular stock index. You can get a return series for your stock, typically monthly for 5 years, and just do a regression. Regress the return of a stock on a return of the market series. So it's just the return on equity, which is a series we'll already have. We'll have a monthly series for this. We'll have a monthly series for the market return, and you regress it, and the regression will estimate beta. And the beta that it estimates is called an unadjusted or a raw historical beta. The estimate of beta here is influenced by our choice of index to represent the market portfolio. So if in the US you use the S&P 500 or the Russell 2000, you will get a different estimate of beta. So it is influenced by the market index that you choose and the length of data period and the frequency of observations. So 3 years versus 5 years, and 5 years weekly versus 5 years monthly, you'll get different estimates of data. So typically, in terms of standards of practice, the most common is to use 5 years of monthly data. That'll give you 60 observations. One of the empirical regularities picked up about beta is that over time they tend to regress towards 1. That companies, as they grow and mature and stabilize, tend to develop a risk profile that is consistent with the market risk. So betas tend to regress towards 1, and since we're doing forward-looking estimates of expected return, we should adjust our beta to reflect this regression towards 1. Most common one is the Bloom adjustment. So our adjusted beta is 2/3 of our unadjusted beta plus 1/3 of the beta of the market itself, and we say the beta of the market itself is 1. So 1/3 of the beta of the market. Why do we put 1 in there? Because it is a variable. It is the beta of the market itself, which we assume is 1. But if we're using a different stock index, it does not necessarily have to be 1. But there it is. So our adjusted beta is 1.2. So if we started with a beta of 1.3, it would be 2/3 times 1.3 plus 1/3 times 1.2. I sort of started from the answer and went to the scenario, right? But you could see that that is a lower beta. It's got a lower risk component. What happens if you have a lower beta? You're going to end up with a lower expected return or a lower cost of equity. Financial data vendors typically provide both adjusted and unadjusted betas. Estimating beta for thinly traded and non-public companies. Well, non-public, I think you can see the problem. There's no return series. For thinly traded, what we're going to have is a series of stale prices. And if you have stale prices, it will understate volatility. And if you understate volatility, you will tend to underestimate beta, which would then underestimate the cost of equity. So ordinary least squares regression won't work because we have no or unreliable return series. So we're going to use a peer company. So step 1, find a peer or comparable company. This is one with similar business risk. And here we can use a classification system. This is a global industry classification system to identify potential peers. All right, next step. If the peer company has substantially different capital structure, which is typically the case, we must unlever the peer company's beta and then relever the beta. So we'll go from an equity beta down to an asset beta, which is a company 100% financed by equity. That's what delevering means. And then we'll relever it up for the level of debt that the target company has. And it's quite straightforward. Unlevered beta, also referred to as an asset beta. We call it an asset beta because assets are financed with both debt and equity. And if we unlever, we get rid of the effect of debt, which means we're just getting an asset beta. So our unlevered beta is the beta of the peer company, multiplied by 1 over 1 plus 1 minus the tax rate times the debt equity ratio. The tax rate here is the peer's marginal tax rate. This beta is the peer beta, and this debt equity ratio is the market value of debt over the market value of equity of the peer. All of this is peer company data, and we will get an asset beta for the peer company. There is an issue here. This assumes that the peer company's debt is investment grade. Because we need the beta of the debt, that is the sensitivity of the debt to the market, to be 0. Typically, investment grade debt is very interest rate sensitive, but not very market sensitive. If the peer company's debt is high yield, it will not have a beta of debt equal to 0. This is not a very appropriate approach to use in that case. So we're assuming that the debt is investment grade. Once we have the asset beta, we can then relever it to get to an equity beta for the target company. So there's the unlevered beta, and then we just multiply it by the denominator here using the target's marginal tax rate and the target's market value of debt and equity, and you will get a levered beta. I'm just going to erase some things so that you can see the algebra of how we get to this equation, from this equation down to here. Since this is 1 over, we can just erase this beta here, erase this, and we could say that it's the same as beta equity over that. Now, if you cross multiply the denominator, you will get this, with BL standing in for BE. And this levered beta is the equity beta of the target. This is the peer, right? And then we're using the target's data to get a beta here. If the target's debt equity ratio is larger than the peer's debt equity ratio, The levered beta, once we re-lever it, will be greater than the peer's equity beta. A good way to see this visually is here. If we think about a company's required return on equity, there's going to be a component for the risk-free rate. There's going to be a component premium for business risk. And then as we add debt, notice that we have an increasing premium for financial risk. Well, the cost of equity using CAPM is the risk-free rate plus beta times the equity risk premium. The equity risk premium is not going to change as a company adds more debt. Same with the risk-free rate. The average risk-free rate over a period of time is not going to change depending on the level of debt that we use. The only thing that can change is beta. So as the amount of debt in the target's capital structure increases, its expected or its required return on equity has to increase. The only thing that can change here is beta. Its beta would have to increase. Let's do a walkthrough of example 8 and example 9. Example 8, estimating the adjusted beta for a non-public company. Rafi Azadian wants to determine the cost of equity for Elucida Oncology, a privately held company. Rafi realizes that he needs to estimate Elucida's beta before he can proceed. He determines that Merck & Company is an appropriate publicly traded peer company. Merck has a beta of 0.7, 40% funded by debt, and its marginal tax rate is 21%. If Elucida is only 10% funded by debt and its marginal tax rate is also 21%, what is Elucida's beta? Well, we've held the tax rate constant. We're going from 40% debt down to 10% debt. We're starting with a beta of 0.7. We'll unlever it to get rid of the 40% debt. Then we'll re-lever it to add in 10% debt. Shouldn't surprise us that we should have a lower beta, right? So let's unlever the 0.7. So it's 0.7 multiplied by 1 over. This is 1 plus 1 minus the tax rate over the debt equity ratio. 40% funded by debt means it's 60% funded by equity. 0.4 over 0.6, we get 0.46. That's unlevered. Let's re-lever it up. And it's 0.1 over 0.9 because it's 10% debt, meaning 90% equity, we get 0.5. Yeah, it's just that straightforward. This shows you a relationship between the debt equity ratio. As we add more debt, look what happens to the equity beta. It increases. So if we have a peer company with a lot of debt and we unlever it and our target company has lower debt, we'll end up with a lower equity beta. But we'll end up with a higher equity beta if it's the other way around. Estimating the weighted average cost of capital. Georg Schremp is the CEO of Bayern Chemicals, a German manufacturer of industrial, commercial, and consumer chemical products. Bayern Chemicals is privately owned and its shares are not listed on an exchange. The CFO has appointed Marcus Meyer, a third-party valuator, to perform a standalone valuation of Bayern Chemicals. Meyer has access to the following information to calculate Bayern Chemicals' weighted average cost of capital. Weighted average cost of capital, what do we need? Weighting of debt, weighting of equity, cost of debt, tax rate, and the cost of equity. Let's see if we can find that. The nominal risk-free rate, represented by the yield on the long-term 10-year German Bund, was 4.5% at the valuation date. If we're calculating the cost of equity, we're using CAPM, we're going to need the risk-free rate. So there it is. The average long-term historical equity risk premium in Germany is assumed to be 5.7%. There's our equity risk premium. All we need is a beta, and we got our cost of equity. Bayern Chemicals' corporate tax rate is 38%. That takes care of 1 minus T. Bayern Chemicals' target debt-to-equity ratio is 0.7. Its capital structure is 41% debt. There's our weighting on debt. Our weighting on equity is 0.59. So we got a couple more variables solved there. We need the return on debt and the return on equity. Bayern Chemicals' cost of debt has an estimated spread of 225 basis points over the 10-year Bund. The 10-year Bund is 4.5. We have RD, which is 6.75%. So we have the weighting on debt, the cost of debt, and our tax rate. There's one component done. We have the weighting on equity, but we don't have a return on equity. But for CAPM, we have the risk-free rate and the equity risk premium. We only need a beta. But this is not a publicly traded company. So we're going to have to find peer betas, unlever them, and then relever them for our capital structure. Exhibit 3 supplies additional information on comparables for Bayern Chemicals, and we have 3. So we have a choice. Do we take 1? Do we take the average numbers and delever the average and relever it, or do we delever each one, take the average, and then relever it once? The correct way is to take each one, delever it, take the average of the three, the average unlevered of the three, and then relever it once. So we're going to need our betas, and we have them right here. We need the debt equity ratio. We need tax rates. There's 30%, 30.3, and 30.5. We're ready to go. So let's unlever the betas. 1.45 over 1 minus the tax rate times the debt equity ratio. And we're just taking the numbers right from the table here. 1.33, 0.94, 1.13. You can see them down here. 133.94, 1.13. Same with the tax rates. These are our unlevered betas. Add them up, divide by 3, we get to 0.6. Now we relever that using the statistics of the target company. And there is 0.6, that's the unlevered amount. There's 1 minus the tax rate, and there is the debt equity ratio of that company. Where do we get the 0.7? Scroll back up. Remember, target debt to equity ratio is 0.7. If you take 0.41, divide by 0.59, because that's the amount of debt over the amount of equity, you'll get 0.7. So there we are, 0.86. This gives us our beta. We have our risk-free rate, we have our beta, we have our equity risk premium. That is our next step. There's our risk-free rate, there's the beta we just calculated, there's the equity risk premium, there's our cost of equity. Now we can finish the weighted average cost of capital, which is down here. We figured out we had 41% debt, which means you have 59% equity. The cost of debt was 225 basis points above the risk-free rate, and our tax rate was 38%, and we just calculated up here 9.4%. Our cost of equity 7.26%. And we end on LOSG, explain and demonstrate the correct treatment of flotation costs. And in this learning objective, we're going to show a wrong way, prove why it's the wrong way, and then show the correct way. Let's define what flotation costs are. When a company wants to issue equity, it's not free. There's a cost. The underwriter has a charge for doing that. Debt and preferred, yeah, there's a charge as well, but it's super low compared to what you would pay for equity. It is the cost to raise additional capital. It's higher for equity and higher for smaller issues. Debt and preferred, very low, typically less than 1%, so it is often ignored in estimating the cost of capital. So typically, we're only incorporating flotation costs for equity issues. Method 1, directly incorporate flotation costs into the cost of capital. And down here, I will show you mathematically why that is incorrect, but this is how it would be done. Now, this is where I'm a little bit troubled by the reading. There is a method of calculating the expected return on equity, a long-term expected return using a Gordon growth model. This is our income component, and this is our long-term growth rate. However, this reading does not show that. Previous versions of this reading in previous years did include the Gordon growth model as a way of estimating the required return on equity, but it's rarely used, which is in practice, which is why it was dropped. But here, we're bringing it in to calculate the expected return. Not because it's a method, but because it's a simple way to prove a point. And all we're trying to do is prove a point, so why use a really complex method to prove a point when a simple one will, right? So our income component is our dividend in one period out. This is D01 plus G, or D1, divided by the price minus F, capital F, if our flotation costs are given in dollars, and we just add G. That'll give us our equity return. If it's given to us in a percent, it is the price multiplied by 1 minus F, D1 over that price, which is the same as this over here, and we'll get a cost of equity. So let's look at this in two ways here. Let's assume we have a dividend of $2. The price of the stock is $40, and our growth rate is 5%. And let's say that we're going to invest in a new product purely with retained earnings. Well, it has a cost of equity, but no flotation costs. So what's our cost of equity? It's D1 over P0 plus our growth rate. We get 10.25%. If we assume that our flotation costs are 4%, saying, okay, well, we don't have retained earnings, let's issue stock to do it. Flotation costs are 4%. What changes is our denominator over here. So this ratio will be higher because it's 210 over a smaller number. We get 10.47% if we adjust the cost of equity for that. Here's the issue. The flotation costs happen only once. But the discounting at this particular rate happens every year on each cash flow. So a simple way to prove that this is not the way to do it is to discount whatever project you're looking at, discount all the cash flows at 10.25%, which is the cost of not issuing any shares. Then discount it at 10.47%, which is the cost of issuing the shares. This one here will, because we're discounting with a higher rate, this will be a higher number minus a lower number. If you subtract the two, it will not equal the flotation cost. So by incorporating it into the cost of capital, if it were the correct way to do it, mathematically, once you subtract one series of cash flows with one discount rate minus the other series with the higher discount rate, it should equal the flotation costs, but it won't equal the flotation costs. I'll show you that in another example. Now, if you're looking for this mathematical sort of statement in the reading, it doesn't give this statement. It just says, you know, it's not going to, it's not the correct method, but really just stop short of saying it's not the correct method for a simple mathematical reason, is the present value of the difference doesn't equal the cost of getting it done. You could have just said that and it would have been done. There it is. All right, method number 2, the preferred method, and the method that you'll use is just to reduce the net present value by whatever the flotation costs are in dollars. So what we're basically saying is, look, F is a cash outflow at t equals 0 and only a cash outflow at t equals 0, so treat it that way. It's part of the initial outlay. And there is an example, and I've laid it out here rather than reading through. Let's say that we have an investment which requires a $60,000 investment and produces $10,000 in cash flow a year for 10 years. Company has a tax rate of 40%. Pre-tax cost of debt is 5%. Cost of equity is 10%, and our weightings on debt and equity are 40 and 60. Of the $60,000, we're going to raise $24,000 in debt, and we're going to raise $36,000 with equity. Our after-tax cost of debt, if our pre-tax cost is 5 and our tax rate is 40%, our after-tax cost of debt is 3%, and our cost of equity is 10%. Weighted average cost of capital 7.2%. Let's calculate the present value of this project using a weighted average cost of capital of 7.2%. We have a 10-year project, payment inflows of 10,000. Future value will be 0 after we get the last 10,000. There's nothing there. We have 7.2%. Present value is 69,591 minus the 60,000. We got 95,91. So what we can do is we can take the flotation costs directly off the net present value. So let's say that our flotation costs were 5%. It's only on equity. Remember, it's only on equity. Debt, we're assuming, is got a flotation cost so low that it's typically ignored in the cost of capital. It's only equity we're paying attention to. So 5% of 36,000 is 1,800. We had 95.91 minus the 1,800, 77.91. But notice now we just took off the straight 1,800. This is cash flow, right? If the flotation costs are tax deductible, which is usually the case, then we do have some tax savings there. So we'll multiply by 1 minus the tax rate. There's 95.91 minus the 1,800. 1 minus the tax rate. 85.11 is the net present value if F is tax deductible. Now, just to prove the mathematical point that I put on the previous screen, there's your net present value, 85.11. Here is the net present value without considering it, 95.91. Had we adjusted the cost of equity for the flotation cost, WACC changes, the weighted average cost of capital changes to 7.3579. The reading just gives us that. It does not trace us through how it gets to 7.3579. It just says, look, we've done the background work for you. You don't need all the calculations. WACC comes to 7.3579. You'd get a net present value of 9,089 if you did that. So we have 95.91 versus 90.89. It does not equal 1,800. So this is the net present value if we had used retained earnings. Let's say we're just going to use a 7.2% because there's no flotation costs in here. This is adjusting the cost of equity for flotation costs and coming up with a net present value. We get 9,089. If this were the correct way to do it, the difference between these two numbers should be the present value of the flotation cost, which is 1,800, which it is not. Or if it were on an after-tax basis, it would be 1,800 times 0.6, or 10,800, or sorry, 1,080, which it is not. And that wraps up this reading.